This is Principles of Financial Accounting, and I'm Dr. Baldwin. This is the first lecture in Chapter 2. In this chapter, we're going to discuss in depth the proper procedures to follow in using the double entry accounting process. You will find this in-depth look a little confusing at first as you go through the chapter. By the time we get to the last screen of the second lecture, you will see just how the system works. The material discussed in this chapter will be used continuously in the remaining chapters devoted to financial accounting, which is basically the whole semester. So you want to spend a whole lot of time on this chapter. It's a great idea to go slowly through this chapter material and to go over it several times. Let's start the process with a little review. Let's take a moment to review the accounting equation and the expansion that shows the elements that affect the equity section. So I've just expanded the equity section there. Notice that the revenues increase equity and the expenses reduce equity. Just a reminder. We begin the accounting process by analyzing source documents. For example, you usually receive a receipt when you pay cash for something. Think about the last time you went to a fast food restaurant. When you received your order, you were giving a receipt, a source document. If you wanted a company to reimburse you for the meal because you were traveling on company business, you must present evidence of your expenditure. This evidence takes the form of a source document, the receipt. Once we identify a business transaction, we record it in a journal. A journal is arranged in chronological order. Transactions are recorded by date of occurrence. At the end of the accounting period, usually a month, sometimes it might be a quarter or a year, but usually a month, transactions in the journal are posted to a ledger account. Posting is the systematic process of transferring information from the journal to the ledger. The ledger groups transactions by the accounts affected. For example, we will have a ledger account for cash. All transactions that result in increases or decreases in the cash account will be posted to the cash ledger account. Once all the transactions have been posted, we prepare a trial balance. The purpose of the trial balance is to make sure all the information has been transferred properly. The trial balance is a listing of all the account balances. So that's the big overview. Business transactions affect the financial position of a business. We can talk about exchanges of value. We give goods to our customers and they give us cash. Or we give cash to buy some inventory, so in exchange for inventory. They can also affect the financial position but not really be an exchange of value. For example, we use up supplies of inventory. We have an asset of supplies, but as we use it up, it becomes supplies expense. Business transactions are recognized according to the recognition principle. We recognize sales and purchases of products when the title to the product has changed hands. We recognize sales and purchases of services when the service has actually been performed. It's not when the cash changes hands, it's when the service has been performed. There are business events that are not transactions and business events that are transactions. For example, if a customer just inquires about a service, that's not a transaction. But if they actually buy a service, pay for a service, or order a service and the service is performed, that's a transaction. Ordering products from a supplier isn't a transaction, but when the products are received, that is a transaction. That's when the title changes. Hiring new employees, not a transaction, but paying employees for work performed, definitely a transaction. Almost all businesses use sales orders, purchase orders, statements from suppliers, canceled checks, bank statements, shipping notices, packing slips, and all other kinds of documents to support the existence of a transaction. In today's highly computerized environment, many source documents are stored digitally. Knowing how to access these digital source documents is an important part of accounting. Here are some more complete definitions of accounts and ledgers. We're going to talk about the general ledger first. Let's just throw these definitions out for you. An account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense item. The general ledger is a record containing all the accounts used by the company. Now let's talk briefly about the general ledger. It contains all of the accounts, so it'll show balances. You can total up the balances for all the accounts. It could be a manual system where each account is on a separate page or a separate card and they're all placed together in a book or a file. Or it can be a computerized system that's maintained on magnetic tapes. If it's a really big company with really big backups, they still actually use magnetic tapes, or on disks, or stored in the cloud these days, which is a little scary because the cloud is sort of this concept, not something we can actually grab onto, but it has to be stored digitally. Lots of options there. Now let's talk more about accounts. Accounts are used to record transaction data. So we have to record the data in a usable form, and it can be quickly retrieved. That's what accounts are for. We have a separate accounts for every asset, every liability, and every component of stockholders' equity, including each different revenue and each different expense. Now let's review a little bit. You already know these definitions from Chapter 1. Resources owned by the company and expected to benefit future operations are assets. Here's a listing of some common asset accounts we're likely to find in all businesses. Prepaid accounts may be new to you. Think about your auto insurance. Many of us pay our auto insurance semi-annually or annually. The payment is made in advance and is referred to as a prepaid amount. It's an asset until it's been used up and it becomes an expense. So a prepaid expense is actually an asset. It's not an expense yet, a prepaid item. That's kind of the weirdo that you got to get used to with assets. Let's talk about liabilities. Liabilities are debts or obligations of the business to transfer assets or provide services to other entities at some point in the future. This is a listing of common liability accounts you're likely to see in the general ledger. A note payable, for example, is a formal promise to pay, whereas an account payable is typically related to the purchase of supplies, equipment, or services. Ongoing account, probably paid, once a month you pay it off. Note payable is when you actually sign. They call it a note because you actually have to sign a sheet of paper, generally, or an electronic equivalent. An unearned revenue is one in which the cash has been received. They've already paid us in advance, but the product or service has not been delivered. For example, if you subscribe to a magazine, you generally pay a one-year subscription in advance. For the publishing company, cash is received, but nothing has been done to earn the revenue. As the magazine is delivered to you, the publishing company recognizes a portion of the money received as revenue. At the end of the year, all the revenue will be earned and the liability no longer exists. We have another liability called accrued liabilities, and we won't even worry about that until the next chapter. Here's a review of the equity accounts we discussed in the last chapter. Common stock, retained earnings, dividends, revenues, and expenses. We'll talk about all of those in this chapter as well. Do you remember the expanded accounting equation we used to record transactions in Chapter 1? Remember that revenues increase the equity side of the equation and expenses decrease the equity side of the equation. I keep repeating that because that's something you really need to get, and you need to get it now. You need to know that. You really needed to know it by the end of Chapter 1. Let's talk about the chart of accounts. The chart of accounts is a list of all the account numbers and their corresponding account names. It helps identify accounts in the ledger. The first digit in the account number refers to major financial statement classifications such as assets or liabilities or stockholders' equity or revenues or expenses. Look at the back of your book and basically turn one page in so that you're looking at page CA. There's actually a page numbered CA, a page or so from the very back. It shows you an example of a chart of accounts, and you'll see that all the assets start with the number 1. All the liabilities start with the number 2, and so forth. So there's a pattern that makes sense. The account titles or names of the chart of accounts should describe what is recorded in the account. Cash is an example, as is equipment or notes payable. An account name identifies the account's classification as an asset, a liability, or whatever sort of account. Different companies, however, use different account names to mean the same thing. If you look at that page CA I mentioned on the previous slide, look at that example, you're getting some typical account names there. The double entry system is the method of recording transactions in the accounts. It is based on the principle of duality. That is, every economic event has two aspects that balance each other. The aspects are things like effort and reward, sacrifice and benefit, or source and use. When cash is paid to purchase another asset, for example, the cash that we're paying out represents the effort, the sacrifice, or the source. The asset that we purchase, let's say we purchase supplies, so we're getting supplies, those supplies represent the reward, the benefit, or the use of that cash. In a double entry system, each transaction is recorded with at least one debit and at least one credit. The total amount of the debits in a transaction always equals the total amount of the credits. That means the total dollar amount. Always. The entire system is always in balance. The T account, so called because the T takes the shape of the letter, you can probably see one there in orange, right? It's a quick way to analyze a transaction before we enter the information in the journal. So we're going to save the journal entries for the second lecture. Let's talk about it from the perspective of the T account. The T account has three parts. It has a title that describes the account. It might be cash, for example. Secondly, it has a left side. It's called the debit side. Third, it has a right side. It's called the credit side. Debit means left. Credit means right. That's all they mean in the context of a double entry accounting system. They don't mean anything else. They don't mean up, down, increase, decrease, good, bad, anything like that. They only mean left and right. This terminology comes from a time when the first double entry system was first developed. I dare you to look up and see how long ago that was. It was a very long time ago. But we still use these terms as a convention. The words really don't have any significant meaning other than they stand for the left side and the right side of the ledger. Footings are the working totals of the columns. Okay, so I'll show you a picture in a moment to show you what that looks like. Those are calculated at the end of each month, so we can get the total for each account. The account balance is the difference between the total debit footing and the total credit footing. So we add up all the debits and we add up all the credits and we find the difference. It's also simply called the balance, the account balance or the balance. If you have a debit balance in a T account, more dollars in debits than you have in credits, you record it on the debit side, which is the left side. If you have more dollars worth of credits than you have of debits, then you record the balance on the right side, the credit side. Now here's a picture of an account with its footings. So we're going to show footings. We have a total debit footing, we have a total credit footing, and then we have the debit account balance in this example. It's cash. It has to have a debit balance. You can't have negative cash. Won't work. Cash is an asset. Assets normally have debit balances. How are you going to remember that? Where are assets in the accounting equation? They're on the left. Which word means left? Debit. That's how you're going to remember that. There are two rules of double entry. Number one, every transaction affects at least two accounts. That means at least one account is debited and at least one account is credited. Now you could debit more than one and credit more than one, but there has to be at least one of each. The total of the debits in dollars must equal the total of the credits in dollars. That means for each transaction that has to be true. And for the whole system, all the transactions, all the accounts added up together, that has to be true. Now, let's talk about the accounts and the accounting equation. Assets increase with debits. How are you going to remember that? Assets are on the left or the debit side of the equal sign. So they're going to increase with debits. So we debit them for increases. We also have to think about what's on the other side. Liabilities and stockholders' equity increase with credits because they're on the credit or the right side of the equal sign. So we credit those to increase them. That means we do the opposite for the decreases. For example, assets are decreased with credits. Liabilities and stockholders' equity are decreased with debits. So that gives you all of the accounting equation and what the debits and credits do. let's talk a little more about what's going on over there in equity, because we've talked about a lot of different pieces of the equity side. The equity side includes common stock, retained earnings. It's affected by dividends, revenues, and expenses. Those are all going to be kinds of accounts we see. Dividends decrease stockholders' equity. Expenses decrease stockholders' equity. So if stockholders' equity normally, that's on the which side? That's on the credit side. But if we're going to decrease them, we're going to do the opposite. So dividends and expenses are going to decrease stockholders' equity with debits. These are transactions that increase dividends or expenses, but they decrease, by their very nature, stockholders' equity, because that's what dividends and expenses do. Revenues increase stockholders' equity with credits. Obviously, revenues and expenses are basically opposites. Transactions that increase revenues increase stockholders' equity. Now that the components of stockholders' equity have been identified, common stock plus retained earnings minus dividends plus revenues minus expenses, just as we discussed in the previous chapter, and their effects on stockholders' equity are understood, the accounting equation can be expanded to include these components. So all I'm doing here is we're taking stockholders' equity and we're inserting these components. You can see that stockholders' equity is decreased by dividends and decreased by expenses. That's important to note. That means their normal balances are going to be different. They're going to be increased in a different way. Those two are increased by debits, whereas other things in the equity section, common stock, retained earnings, and revenues, are going to be increased by credits. Now let's talk a little bit about normal account balances. Normal balance means the usual balance. It refers to whether increases in the accounts are made with debits or credits. Accounts that are increased with debits have a normal debit balance. So cash, or any asset that's increased with debits, which is the way assets normally are, they're normally going to have a debit balance. Accounts that are increased with credits are going to normally have a credit balance. Some accounts may have an abnormal balance. That is actually possible, and you have to copy them into the trial balance exactly as they stand to figure out what's going on. Recall the basic accounting equation. Assets equal liabilities plus stockholders' equity. Assets are increased by debits, but liabilities and stockholders' equity are increased by credits. However, dividends and expenses decrease stockholders' equity with debits. We increase them with debits, but that does what to stockholders' equity? That decreases stockholders' equity. So dividends and expenses must normally have a debit balance. You have to think that through. Remember, we've shown you 5 elements of stockholders' equity, but 2 of them have the effect of decreasing stockholders' equity. Therefore, their normal balance must be the opposite of equity in general. So assets normally have a debit balance. Dividends and expenses normally have a debit balance. Liabilities normally have a credit balance. Things like common stock and retained earnings normally have a credit balance. This is going to make more sense to you as we put it all together. Let's review the process here. In the accounting process, you first analyze a transaction by looking at proper source documentation. Next, we apply the rules of double entry accounting and record a general journal entry. The general journal is a chronological listing of the transactions. At the end of the accounting period, we post the information from the general journal to the proper general ledger account. The general ledger groups all those transactions together that affect a particular account. That is, all the transactions that increase or decrease the cash account are going to be posted to the cash general ledger. There's a 5th step. The 5th step is to prepare the trial balance. Now let's talk briefly about that. What's a trial balance? It's a test. It's there to prove that debits really do equal credits, because if they don't, you've got a problem. It's usually prepared at the end of a month or of a larger accounting period, but it can be prepared at any time just to check. It will drive you absolutely crazy if it's out of balance because you know something is wrong. What a trial balance does not do is prove that all the transactions were analyzed correctly. It doesn't prove it. does not prove that amounts were recorded in the proper accounts. It does not detect whether transactions have been omitted. It does not detect whether errors of the same amount have been made, both in a debit or a credit. What does it do? It shows that the debits and credits are equal. How do you detect errors in the trial balance? Here's some little clues. If the debit and credit columns are not equal, look for the following errors. Look for a debit that's been entered as a credit, or vice versa, or an incorrectly computed account balance. So you've got one of your account balances is just wrong, or an error in carrying the account balance to the trial balance, or an error in adding it up, basically an addition, a summation error. A trial balance out of balance by an amount that is divisible by 2 means an account with a debit balance was recorded as a credit, or vice versa. A trial balance out of balance by an amount that is divisible by 9 means 2 numbers were probably transposed when transferring an amount to the trial balance. These will be handy to think about later when you're trying to find your own errors. Now, I mentioned in the last chapter that every chapter has a small section on financial statement analysis, and I'm going to go ahead and talk about that small section in this chapter now. It's the debt ratio. The debt ratio tells us about the relationship between liabilities and assets of the company. It shows us how many dollars of debt exist for each dollar of assets owned by the company. We can use this measure to assess the risk associated with the future operations of the company. So it helps measure risk. That's the debt ratio. We have reached the end of this lecture video. Remember, this is only the first lecture video of 2 in this chapter. This chapter and the first chapter are really the crux of you going on to the rest of the chapters. You've got to get these pieces pulled together for yourself. Even though it seems pretty weird at first, you've got to keep going until it clicks. It's time to go on and start working on the homework for the first part of this chapter. You might want to work on the Learn Smart for a while first, but the homework is going to take a lot of time, so you want to make sure you don't leave it to the last minute. Work on it some and then go work on Learn Smart for a while, or work on it some and go work on another class for a while. But it's going to take a good amount of time, but don't try to do it all in one big block of several hours. You don't want to do that. You want to spread it out. Good luck.